you to Metrics Credit Partners. Metrics Credit Partners is a business that we established in 2011. It was really born out of the dislocation that occurred in the market through the GFC. So myself and my colleagues previously worked at National Australia Bank. I spent 26 years working there. My colleagues have all had 25 to 30 years experience working within regulated banks, originating transactions with Australian companies, structuring those transactions, negotiating the terms and conditions, providing the finance, and then managing the risk associated with providing finance to those companies. It's a skill set that really resides only within banks. And what we saw in the middle of the GFC was a lot of European banks, Asian banks, American banks and others withdraw from the Australian market as they face troubles in their home market. And it created an opportunity for us to present to NAB at the time and to say, look, our view is that the Australian market is going to change. You're going to be subject to increasing levels of regulation. And as a result of that, with pools of capital sitting in superannuation funds and the like, there's a real need to be able to bring an asset class to a market that can provide direct exposure. And I guess fundamentally in Australia, the reason we exist is really that there is no deep functioning corporate liquid bond market. So it's very difficult for investors to get access to the stability of capital and the attractive returns that are associated with direct lending to Australian companies. So we lend in a very vanilla way. There's no leverage, there's no derivatives. We lend short-dated facilities, and predominantly our facilities are short-dated, between 3 and 5 years. The exposures are all floating rate, so in a rising rate environment that provides protection for investors. The reason we lend for terms between 3 and 5 years generally is because, in our view, that reduces the credit risk that our investors are exposed to. You can obviously project out where a company might be able to trade and perform over a reasonable period of time, but beyond 3 or 5 years it starts to become more difficult and the credit risk is increasing. We lend for a short-dated period as well because we believe it reduces the exposure to changes in credit spreads that our investors would be exposed to. It drives enhanced liquidity in the underlying pool of the loan assets that we hold, and it also drives an opportunity to outperform in terms of fee income that can be generated for our investors by charging refinance and extension fees and the like, that it becomes income to our fund investors. So as I said, we started in 2011. We launched our first fund in June of 2013. We started with one single investor for $75 million. We now run about 7 different funds and in excess of $3 billion of funds under management. In October of last year, we launched an ASX listed fund. That ticker code is MXT. It's the MCP Master Income Trust. That fund seeks to provide investors with stability of capital, low risk of capital loss, regular predictable monthly income, and a return of the RBA cash rate plus 3.25 net in the hand to the investor after fees and costs, with income paid monthly. And since the launch of that fund, we've delivered exactly that. Our investors gain the benefit of being exposed and diversified across a holding of in excess of 80 individual loans through MXT. So the companies that we lend to, we provide funding to Australian corporates, both publicly listed companies and to private companies. We provide funding for project and infrastructure related financing, so the likes of the Eastern Distributor or the Victorian Cancer Centre in Victoria. We provide funding for property purposes, both for development funding and also for REITs. Provide funding to the likes of Lendlease or Charter Hall in a REIT context, but we also provide funding to a range of private developers. We provide acquisition financing, predominantly for private equity firms. What this provides to our investors is the ability to gain direct exposure to Australian companies, diversified across the credit spectrum, and generate the returns from that direct lending activity. I guess unlike other markets, we exist because in Australia we don't have a deep functioning liquid bond market. The Australian market is heavily bank dominated, it's heavily regulated, and we saw an opportunity to bring our skill set in terms of the capacity to originate transactions, to negotiate those terms, set appropriate covenants, controls, take security, and provide funding to companies alongside the banks. many of the facilities that we participate in, other banks join us. The facilities are too large for the balance sheet of an individual bank, and so we generally share that risk amongst a number of lenders, and that's where we participate and participate in those transactions alongside the banks. We also provide bilateral facilities where we are the single lender. Again, this really shows here that the Australian loan market is the most dominant market for Australian companies to raise debt funding, generally because most Australian companies don't have credit ratings, and as a result of that, they tend to be locked out of public markets. But our view is that investors are far better off gaining exposure to this market in a pooled vehicle where you can gain exposure to the companies such as those on the screen in a diversified pool where your capital can be commingled with other investors to allow us to lend in a size and scale commensurate with the way in which a bank lends. So most investors might be offered small ticket positions in bonds from different distribution firms, or offered a hybrid, or put money into a term deposit. They're very different instruments. You know, if somebody came to us and asked us to provide funding on the basis of a perpetual unsecured, subordinated, convertible note, we would say that that instrument has characteristics more akin to equity rather than a debt instrument. So for us, when we lend, we're looking to structure the appropriate terms and conditions to mitigate the downside risk of capital loss to our investors. Equity should be the more volatile part of the capital structure because you're investing in equities to gain growth. As a lender, we're providing debt securities or debt obligations to the company. The company, we lend $1, we expect that company to pay us the interest and fees and repay the principal on maturity. And so as a result of that, you structure terms and conditions to have a granular understanding of the credit risk associated with the company you lend to, and you set appropriate controls so that equity wears its share of the risk. There's no upside gain in terms of providing risky loans or being involved in a situation where there's some outperformance of the company. For us, we're a lender, and so we're looking to provide stability of capital to our investors in a diversified pool where we can bring a skill set to be able to negotiate appropriate terms and conditions, and where we can have the capital that we provide to the company appropriately valued and priced. And therefore, we believe providing capital in a scalable way, in a way similar to the banks, you're able to extract the appropriate terms, conditions, and the appropriate price because capital is scarce. If you're a corporate and you're trying to raise debt capital outside of what is the risk envelope of the 4 domestic major banks, it's extremely difficult to raise debt. We don't have the deep, liquid institutional markets. So what we look to provide is the Australian market tends to be, because it's a bank-dominated and regulated market, the credit risk characteristics of the market is generally from A-rated credit through to BB. And that's the market that is a bank-dominated market. Those assets currently sit on bank balance sheets. Contrast that to, say, the US market, and some investors have exposure to the US high-yield market, or what we call the Term Loan B market. That is at the other end of the risk spectrum. It's an institutional market. It's unregulated in the context of banks that participate. And generally, the credit risk is between BB and CCC. And what we've tried to outline on that chart is really just the different markets. So when we think about corporate debt or mezzanine or distressed, that's moving down the credit spectrum. You know, at Metrics Credit Partners, we're not lenders of last resort. We're not lenders that sit here and say every transaction has to be priced at a particular level because there's absence of capital. Our view is we lend to high-rated companies, we lend to sub-investment grade companies, but we seek to negotiate appropriate terms and conditions to mitigate that downside risk of loss. And I guess the other benefit in Australia is that because it's not only a bank-dominated and regulated market, but corporate insolvency and the corporate insolvency framework in Australia is very friendly to lenders. So as a lender, if you're providing funding on a secured basis, you rank ahead of unsecured creditors and you rank ahead of equity. And so as a result of that, even in the situation where the company might experience a downturn in its earnings, or it's a downturn in the value of the company, you might wipe out equity. But it doesn't mean that you as a lender are exposed to capital loss. You've got the rights to take action under the contracts and the documents that are entered into between the lender and the company you lend to. And those contractual rights provide protections for you to ensure that even in the period where there might be a downturn in performance of the company, you've got rights to protect yourself. So what we tend to see in the Australian market is that the banks are the dominant price setters of the price of credit. So if interest rates rise or it becomes more difficult to raise capital in offshore funding markets, so for instance, currently you're seeing interest rates rise in offshore markets as a result of that. That has flow-on effects in terms of the bank's own cost of funding. They adjust that by changing interest rates on deposits paid to retail and institutional clients, to manage a cost base. So from the bank's perspective, they're looking to raise capital through equity, hybrids, term deposits from investors and savers, and also from term issuance in debt wholesale markets. The combination of all of those things sets the price upon which a bank will lend, seeking to then generate an equity-like return for their shareholders above that. So if banks are exposed to increased costs of funding, and you saw that, it's often commented upon when the banks made out-of-cycle interest rate rises for home loan customers. It's because their cost of funding has gone higher, and so they pass through that cost of funding to the borrower. For us, what that delivers to our investors is obviously an increasing total return. You can see on the chart to the left the spread between the base rate, the RBA cash rate, or what we call the bank bill swap rate, or BBSY, where loans are priced over. There's been a consistent spread, really recognising the fact that the banks in the market look to generate a particular return over their cost of funding. What we seek to deliver our investors is similar to that middle chart. That middle chart shows the credit risk dispersion of the 4 domestic major banks, and what we seek to provide our investors is with a market risk exposure consistent with the way in which a bank's balance sheet is positioned. You can see as you go down the credit curve, the risk to a lender in terms of default and potential credit losses increases exponentially. So from our perspective, credit protection, credit management is central to the way in which you generate returns for investors. Anyone can manufacture a yield, take high risk and try and generate high returns, but it's the stability and protection of capital over a long period of time that delivers total returns for investors in our view. The market, given it's regulated and given the nature of the market, you can see the loss rates are particularly low, and that's a function of not only the regulated nature of the market being a bank-dominated market, but it's also a reflection of the Australian corporate insolvency framework that provides lenders with protections. Yet most Australian investors, particularly retail or self-managed super fund investors, don't have the ability to gain exposure to this asset class. Most portfolios are heavily dominated towards equity or property, and investors don't have the benefit or the ability to really gain exposure to a capital stable asset class, providing predictable known cash flows and income on a regular basis. That was the driver for us in terms of launching the MXT product to the ASX in October of last year, trying to give investors an alternative to term deposits, giving investors an alternative to other corporate bonds, or give investors alternative to hybrids. This is the design of our fund structure. We have an ASX-listed fund. Most of our capital is flowed into our underlying wholesale funds. We operate a diversified loan fund. We operate what we call our secured private debt fund, which is a mid-market corporate fund, and we operate a real estate debt fund. 60% of the capital that was raised from the MXT capital listing, or the listing on the market, flowed into our large-scale diversified fund. That fund seeks to provide investors with a return of around about 300 basis points over BBSW. The real estate debt fund received 20% of the capital. It seeks to provide a return to investors of bank bills plus 500, and the secured private debt fund seeks to provide investors with a return of bank bills plus 400. So the combination and the split of those assets and the way in which the capital is diversified folds up into providing our investors liquidity through the ability to trade units on the exchange, but gaining exposure to a predictable monthly cash income flows with a relatively stable capital value. We listed in October last year, as I said, at $2. The unit price on that vehicle has not traded below the NAV since listing, and in fact it's been bid up as people have recognised the stability of the asset class and the predictable nature of what is an attractive alternative yield. That's the historical returns for our wholesale funds. So the first fund, as I said, was launched almost 5 years ago. We've had consistent monthly performance, recognising the position you sit in the capital structure of the companies that we provide credit to, but also the consistency in terms of the way in which we manage credit risk and generate returns for our investors. We seek to drive returns for our investors through fee income that's charged to borrowers, protection and appropriately pricing credit for the risk, and ensuring that the facilities are short-dated, driving opportunities to create liquidity and allocate our capital across funds. The next two slides, or the next three slides, show the historical return of the other funds. This was the first version of our secured private debt fund that was established in November of 2015. That's a high-yielding fund strategy. Investors in our wholesale funds tend to be superannuation funds, life insurance companies, high net worth individuals, fund of funds and the like. And this is the Secured Private Debt Fund 2. We're part of the capital for our ASX listed vehicle flowed into since October of last year. And again, our real estate fund strategy. We see the real estate fund strategy as being particularly interesting at the moment, as the regulators and APRAs have pulled back the bank's appetite in that part of the market. The interesting thing for us as a lender, we came from a particularly underweight position lending to property, and we've now moved that higher, largely reflecting the gap in capital that's been caused as a result of the regulatory changes. And so as the regulators put pressure on the banks to constrain their lending books, particularly to property-related transactions, what we have found is that the terms and conditions have improved. They've become tighter. Capital has become scarce, and it therefore becomes appropriate to charge higher pricing. And those returns are able to then be delivered to our investors. To give you an example of that, previously the banks may have lent to a property development transaction at a senior on completion loan to valuation ratio of maybe 65%. They've pulled that back now to around 45 to 47%. So the gap between that 45 and 65% is either being funded through alternative debt providers or through additional equity being required to be injected. But the price of the total cost of funding has moved materially higher. The total loan to valuation ratio that a borrower might be able to achieve is still not greater than 65%, but the total cost of that capital has been increased. So it was just a bit of a snapshot in terms of our funds and our operations. So thank you very much for the opportunity to present.